Hi and welcome back to another options newbie tutorial. Today is October 14th, 2017 on Saturday. Just wanted to do a video, doing you can say covering credit spreads on here. We're going to do call and put credit spreads, so we might as well just do it all on one video because they're the same obviously, but they're obviously you're looking at the stock going in different directions depending on if you're doing the call or the credit spread on here. So, all right. So what is a credit spread? So you're selling an at the money option and buying an out of the money option for credit. Okay, obviously it's the opposite of what a debit spread is. So for a call credit spread, so why would you do a call credit spread? So you're either neutral to or mildly bearish on the stock, and I'll explain that in a minute. Inversely, for a put credit spread, it's the opposite, right? So you're neutral to mildly bullish. Now, I say mildly bullish or mildly bearish. What I'm trying to say is, if you're really bearish on a stock, just buy a put. If you're really bullish on a stock, just buy a call. Right? So with a credit spread, like I say, you just have to be neutral to mildly bearish on there, right? In order to profit on these. Okay. So let's get into an example here. Okay. So we're going to use the SPY, the S&P ETF. Okay. So again, this is for educational purposes. This is not a recommendation. Okay. So as of these are closing prices as of Friday the 13th. Okay. So SPY closed at 254.95. So if we're doing a credit spread, and I went out like 2 weeks. I went out to the October 27th options chain on here. So if we sell 10 contracts of the 255 call, okay, for our call credit spread, and bought 10 contracts of the 257 call, right, you're going to get a credit of 87 cents. So times that by 10 contracts, right, $870. That is the credit you're going to receive for that. So what is our loss on this? What is our max loss? Well, basically it's just the difference between the two strikes. So between 255 and 257, that's $2 minus that 87 cents, right? And you're going to come up with $1.13 or $1,130 based on our 10 contracts that we're doing on here. So that's your max loss. Break even, simple. You're just adding the 87 cents onto the 255 call. So 255.87 is going to be your break even point. So obviously, if the stock goes to, like if it's at 256, right, then at that point you're going to have to do something. So you have to, if it finishes at 256, you basically buy back the call. You're going to lose 13 cents on that, or $130, right, if it finishes at that price. So you can see, obviously, you want it to, be at 255 or below. Right? If it's below the 255, you don't have to do anything. You've already gotten your premium. You don't care about the the 257 call expiring, because, like I say, you've got your premium in that case. Done deal. You only have to worry about it if it finishes. If it's finishing between the strikes. All right. Or of course, if it finishes outside of the strikes, again, you don't have to worry about your max loss. You're capped out at that max loss of 1,130. But obviously that's your worst case scenario on there. Okay, so let's take a look at it on on my paper money account. Okay, so again, here we are selling the 255 call. Buying the 257 call. There's our 87 cent credit. Right, and there's the numbers. Right, there's our max profit 870, max loss 1,130 on there. Okay, let's look at the put spread. Again, it's just the opposite of the call spread. Just have to think about it a little bit differently. So again, same thing. Take the SPY 254.95 where it closed out Friday. So, but in this case, you're selling the 255. This is October 27th at the money puts, but buying the 253 out of the money puts, right? Because 253 is going to be out of the money, in terms of a put on here. Okay, but for this one, you want to be slightly bullish, neutral to slightly bullish on this one. Okay, you want it to go up, you don't want it to go down. So 49-cent credit, not as good. Obviously, the on this one, 10 contracts, so $490 is your max gain. All right, again, your max loss. It's that difference between the strikes. So $2 is the difference between the strikes minus that 49-cent credit. So $1.51 max loss, or $1,510 on 10 contracts. Again, your break even. Again, simple. You're just taking that 255, except you're subtracting the 49 cents. In this case, to come up with your break even of 244.51. So in this put spread scenario, obviously you want it to finish higher, than the 255 price on here. Okay, to achieve your maximum gain on this one. Okay, so let's look at it again. I'll pull up my paper money account here. We'll change these to puts. Okay, 253. There's our 49-cent credit. Right, there's our numbers on here. Now, you can try to get a bit more credit on here by simply just expanding the strikes. All right, so here we got a 62-cent credit if we go down to the 252 put on here. But keep in mind though, when you expand the strikes, you're also going to expand your max loss as well, because then now you have a 3-cent difference. Sorry, $3 difference. My apologies. So here we are. 620 is your max profit, but then your max loss is $2,380. Okay, so you're definitely adding on more risk to get a bit more credit on there. Okay, but anyways, that's pretty much call and put spreads. Again, pretty much a brief video on this. So you get into some more detail about them in some future videos. But I just wanted to sort of keep it simple, for now. So if you do like these videos, please give me a thumbs up, subscribe. Can always appreciate any comments, suggestions that you can give to me. If you want to see anything in future videos, let me know, and I'll certainly try my best to make it happen. I plan on uploading a couple more videos next week. Not sure what I'm going to do them on yet, but I'll figure it out. Anyways, have a happy weekend, happy trading, and I'll talk to you later. Bye for now.